Is the Pramerica Life Wealth Plus ACE plan truly the ace up your sleeve for long-term wealth creation or just another over-promising ULIP? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster plus smarter way. So before we analyze this policy, let us first understand a few basic details about it. So this is a unit-linked non-participating individual savings life insurance plan, and some of the key features of the policy are: you can make a one-time investment and enjoy the benefits of this policy throughout the policy term, and this company adds persistency units to your account at the end of every 5th policy year beginning from the 10th policy anniversary. So you can also choose to invest a fixed amount monthly through the systematic transfer plan, and the sum assured is determined based on the age of the life assured at the time of entry of this policy. So these are some of the key features of the policy, and there are benefits like maturity benefit, death benefit, and persistency unit. So as a unit linked policy, there are also 9 to 10 fund options available for you to choose from based on your risk preference and also financial goals. You can choose to invest in any. But as a unit linked policy, there are also certain charges that you need to pay, like premium allocation charges, policy administration charges, mortality charges, fund management charges, discontinuance charges, and other charges. So these charges place an additional burden to the investor. Unlike other equity linked investment options that involve minimal or no such cost, these deductions gradually erode returns over time, thereby limiting the overall potential for wealth creation. So we need to consider this as a drawback. So some of the advantages of the policy are: a one-time payment offers a simple and hassle-free investment experience. At policy maturity, you can choose to receive the maturity benefit as a structured payout spread over a period of up to 5 years, and partial withdrawals are allowed from your investment account only after completing 5 policy years, which is the lock-in period. And you also have the flexibility to switch between funds based on your changing financial goals and investment preferences. So these are some of the advantages. However, there are some disadvantages like no loan facility available under this plan, and access to funds is restricted during the first 5 policy years, and the sum assured may also not be insufficient to cover a family's essential financial needs. And after deducting the applicable charges, only then your net premium is invested. So these might be some of the disadvantages that you need to keep in your mind before deciding to invest in this policy. So now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the benefit illustration given in the policy brochure. But if you still want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So for calculation purpose, let us assume that a 30-year-old male has invested in this policy with a policy term of 20 years, paying a single premium of 5 lakh. So the sum assured under the plan is 6,25,000, which is 1.25 times the single premium. At maturity, he receives the fund value, which depends on market performance, and the assumed return rate of 4 and 8% in this policy are merely for example purpose and not guaranteed. So they do not represent the upper or lower limits of potential returns. These are just to show you how this policy can perform at worst and best case scenarios. So at 4% return, the fund value is 8.05 lakhs, resulting in an IRR of 2.41% as per the policy's maturity calculator. So this reflects almost no real wealth creation, as the return barely keeps pace with inflation. At 8% return, the fund value is 17.12 lakhs, giving an IRR of 6.35% as per the policy's maturity calculator. So even in this optimistic scenario, the return is comparable to or lower than that of debt instruments. So the IRR analysis here clearly indicates that this policy fails to deliver inflation beating or meaningful real returns. So investing your lump sum in this plan could restrict your wealth accumulation potential, as the returns do not justify long-term capital growth expectations. So as this policy is not giving us the desirable outcome that we need, let us now move on to a comparative analysis, where we are going to take up an alternative approach in which we are going to invest in insurance and investments separately instead of like in a combined policy like Pramerica policy. So here, for life cover purpose, we have taken a pure term life insurance policy offering 6.50 lakhs coverage for 20 years, which can be purchased with a single premium of 31,300 rupees. So here we have taken up same parameters from the earlier example for a fair comparison. So considering that, this leaves us with 4.68 lakhs available for investment. Depending on the investor's risk appetite, this balance can be allocated to debt or equity instruments. For this comparison, let's consider an equity mutual fund for this example. So assuming average market returns, the pre-tax maturity value of the equity mutual fund investment, would be 45.21 lakhs. So after factoring capital gains tax, the net maturity value comes to approximately 40.30 lakhs, delivering a post-tax IRR of 11%. So if you have any doubts regarding how we have calculated the tax for equity mutual fund, you can see that we have presented a small tabular column on the screen before you for your easy reference, which you can pause and see. This comparison here clearly demonstrates that separating insurance and investment offers greater liquidity and superior returns. In contrast, this policy lacks both liquidity and inflation-beating returns, making it a less efficient choice for long-term wealth creation. What is the final verdict then? Is investing in the Pramerica Life Wealth Plus ACE plan worth it or not? So investing a lump sum in the market is the key selling point of the Pramerica policy. The fund value along with persistency units is payable to the Pramerica policy holder. However, after analyzing the returns, it becomes evident that this lump sum market linked investment does not deliver higher returns despite being positioned as a growth oriented product, and it also has a high agent commission. So this policy falls short in supporting genuine wealth creation. Single premium ULIP like this one are inefficient for building long term financial strength, primarily due to high charges and limited flexibility. So there are better alternatives available that offer lower cost, higher liquidity and superior returns. So having equity exposure in your portfolio is indeed vital for long-term wealth building. However, it's wise to avoid ULIPs and instead choose investment products that match your risk profile and financial objectives. For life insurance needs, a pure term policy remains the most cost-effective solution, providing adequate protection while allowing you to invest the remaining funds more efficiently.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.